Hi everyone. This will be the review for the final. The final will have 25 questions, just a few conceptual questions. The rest will be calculations, very similar to the review sheet that I sent out. So I'm going to work through the review sheet tonight. The test will open Friday morning at 6 a.m. and close midnight on Sunday. Conceptual questions, just a few. One related to advantages and disadvantages of different business organizations, such as comparing a sole proprietorship to a corporation. A simple question about capital budgeting, just what that decision is, what we're doing. A question comparing the assumptions of modified internal rate of return and internal rate of return. And then the last conceptual question will relate to strengths and weaknesses of the payback period model. So let's go ahead and go through the review sheet. The first question is asking about changes in net working capital. So I have the numbers here. We have 2011 and 2012, so we want to see the change from 11 to 12. The first step is to calculate net working capital. So to do that, we're going to take all our current assets, cash, accounts receivable, and inventory, add those, and then subtract accounts payable. So we get 10,100 for 2011, 9,900 for 2012. Take the 2012 minus the 2011, and we'll get minus 200 for that change. And I'll send out this file also. The second question asks for calculation of operating cash flow. That is earnings before interest and taxes plus depreciation minus taxes. So here we have earnings before interest and taxes of 1,800, depreciation of 1,700, and taxes of 300. So our operating cash flow then will be the 1,800 plus the 1,700 minus the 300. So we get to that 3,200 number. The third question, and for the first question too, just be careful about ordering so you get the right sign. We want to know the amount of net spending in 2012. So we're looking at a change from 2011 to 2012. So we're going to take net fixed assets in 2012 minus net fixed assets 2011. But that's not fully accurate as far as how assets changed because we had a write down. So we need to add back whatever was written off in depreciation. So we'll take net fixed assets 12, net fixed assets 11, and depreciation. Depreciation is 1,700. Net fixed assets in 2012 was 20,000, and it was 21,000 in 2011. So the net fixed asset number actually decreased, but the assets of the company didn't decrease. What they have, the difference is the depreciation. 1,700 was written off in depreciation. So we'll take net fixed assets in 12 minus 11 plus depreciation to get to 700 for the amount of net spending in 2012. Okay, so let's move on to number 4. Okay, number 4 says that a company has ROA of 14%, equity multiplier of 1.5 and dividend payout ratio of 0.7. So what we're looking for here is the firm's internal growth rate. So internal growth rate, we know that's equal to ROA multiplied by B divided by 1 minus ROA multiplied by B. And we know that B is our retention ratio, which is 1 minus our dividend payout ratio. So B has to be equal to 0.3. And we know the ROA, so we can go ahead and plug things in here. So we'll have 0.14, 0.14, 0.3, and 0.3. So if we do the math there, 0.14 multiplied by 0.3 divided by 1 minus 0.14 multiplied by 0.3, and we get 4.38%. So the equity multiplier there was just extra information. So that was number 4. Number 5. A company has a capital intensity ratio of 1.3, profit margin of 0.057, and a debt equity ratio of 0.35. And we're looking for ROE. And we know ROE is profit margin multiplied by total asset turnover multiplied by equity multiplier. So we have a couple of helpful equations to remember here that we've talked about before. So 1 plus the debt equity ratio equals equity multiplier. So the equity multiplier is going to equal 1 plus the 0.35 debt ratio. So 1.35. And we also know that total asset turnover ratio equals 1 divided by the capital intensity ratio. So if we take 1 divided by the 1.3, we get about 0.77. So now we have everything for ROE. We're going to take profit margin, multiply that by total asset turnover, multiply that by equity multiplier to get about 5.9%. On to number 6. A company has net income of $8,000, interest of $4,000, cost of goods sold $2,700, and depreciation of $700. What is times interest earned? So times interest earned is equal to earnings before interest and taxes divided by interest. Hopefully our earnings before interest and taxes is a big multiple of our interest. Otherwise, as a business, we're cutting it kind of close. So we have our tax rate there too. So this is a kind of, we're working from the bottom up on this one. So let me make sure I labeled this one. Okay. So we have earnings before interest and taxes. We would have interest here, earnings before taxes, taxes, net income. So what we know that net income is 8,000. Based on the tax rate, the rate is 0.32. So we know that net income equals earnings before taxes multiplied by 1 minus the tax rate. This is a step that I think logically you might not jump to this. You might jump to multiplying by 1.32. But what you need to do is take your net income of 8,000 divided by 1 minus 0.32. So it really bypasses this tax step, and it takes you up to earnings before taxes. And you know your interest is 400. So earnings before taxes, then you're going to add these two together. So to calculate times interest earned, we're going to take this number, earnings before interest and taxes, divided by interest, and we get the 30.41. Number 7, you invest in real estate at a cost of $200,000. It's been appreciating at an annual rate of 11.2%. How long until it's worth $500,000? So these next few are your time value of money, the basic problems. So we have present value, future value, I, and N. No annuity payment. So for our present value, we're going to put in our negative numbers. So minus 200,000. Our future value, we have $500,000. Our interest rate is 11.2. We don't know N, so we're going to use the NPER function. We use our rate. Our payment is 0. Present value is 200,000. Future value is $500,000. And we get the 8.63 years. Sorry, one sec. Okay, on to question 8. Similar problem here, but now we need to know the interest rate. So bought a collectible car for $50,000. That's going to be our present value. It's worth $29,900 now. So you can't always assume it's easy to jump to making money on an investment and reverse present and future value if a loss is going to occur. In this case, there's a loss, so you expect a negative annual rate of return. The number of years is 3. So now we're going to use the rate function. The number of periods is 3. The payment is 0. Present value minus 50,000. And the future value is 29.9. And I must have done something wrong here. Let's try again. So rate, number of periods, payment is 0. Present value is minus 50. Future value is 29.9. So we get the minus 16%. And I'm going to go ahead and do 9 on here too. So 9 is using a rule of 72, where you're going to come up with an approximation rather than an exact number. And for 72, the rule of 72, the number of years to double based on the annual rate is equal to, and this is for reasonable interest rates. If you put 80% in, it's not going to be as accurate, but reasonable rates divided by the rate. Now with the rate, In this example, it's 13%. You're going to take 72 divided by 13, not 72 divided by 0.13. So the number of years here, we're going to take 72 divided by 13. So we get about 5.5 years. So if you calculate the exact number, you might look at the multiple choice and say, what's going on? But a question like this is intended to use the rule of 72. Now number 10. Your current annual salary is $90,000. Your first job paid $33,000. How long have you been employed if your average annual salary increase was 8%? We can treat this just like an investment. So present value, you started with $33,000. You ended up at 90, 8% per year annual raise. So now we can use the number of periods, that formula with the rate, no payment, present value, future value, to get to about 13 years. This is essentially the same problem packaged or presented a little differently. So you start with the ability to produce 100,000 bushels. You want to know how many years it's going to be so you can produce 130, given a growth rate of 2.5%. So again, number of periods. We have our rate. We have no payment, present value, future value, and we get to the 10.625 years. Number 12, you're saving to buy a home in 5 years. You estimate it's going to cost $275,000. So that's how much you need. Actually, you need a 10% down payment. So your future value, what you need is $27,500. How much do you have to invest? Actually, I'm going to be consistent. Do this. How much do you need to invest today? So what present value do you have to invest so that you can cover the down payment in 5 years, assuming a 10% interest rate can be earned? So we want present value, our number of periods. Sorry, it wants our rate first. Our number of periods, no payment. We're going to make just one investment now. And we need our future value. So you need to invest a little over $17,000 to cover that payment. And now we're on to the questions which are going to include payment. So we'll add payment here. For 13, you know you can afford to borrow, or you can afford $400 a month for 4 years. Now, here we're going to assume we have to use 48 periods because of the 4 years. We have a 4.75% interest rate, but we have to divide that by 12 because we're dealing with months here. And on questions like these, the present value, I mean, you'll have multiple choice, but if something comes out and you feel like this is way, way off, very likely the adjustment you need to make. Our future value is going to be 0. So let's see how much we can borrow. So present value, we have our rate, our number of periods, our payment, and our future value is 0. So you're going to put in a negative payment there. And you end up with $17,454. That's how much you could borrow. $14, same idea. Now we're going to calculate the payment. So we're going to buy a boat. On these loan problems, we're always going to assume the loan's paid off. So you put in a future value of 0. 6.9% interest. So we're going to again divide that by 12. And we're going to do 36 months. So we want to know our payment. So payment with our rate, number of periods, present value, future value, and that's about $300 a month. Okay, 15, another time value money problem. Over the past 30 years, your parents have saved for retirement. How long it took them to save is not material here. With their current present value, they have $900,000. They're going to spend it all. No inheritance for the kids. No, how much can you spend each year? So we're going to use this rate of 6% they earn as an annual rate, 35 years, and see effectively what can they withdraw from this, assuming it continues to earn the 6% interest. So use payment, rate, 35 years, our present value, and our future value. So they can spend about $62,000 a year, so not bad. Okay, on to 16. So you're investing $20,000 in an account today, and then $200 per month thereafter. You can earn 6% monthly compounding. What will you have in 5 years? Okay, so the present value, you invested $20,000. And I might mess up the signs on this. We'll get the signs right, and I forget about this one. The payment, we're going to put it in negatives now. We might have to change those. The number of periods is going to be 60 because we're dealing with monthly. And you're going to earn 6% interest. So on a monthly basis, we're going to divide that by 12. And you get 0.5% a month. So for future value, we use that function with the rate, the number of periods, our payment, and our present value. And you end up with about 41,000. So you do put in the present value and the payment, both with negative numbers to come up with this future value. Okay, now changing gears, and we're going to go to bonds. So this is a bond pricing question. Have your time. This would be a 10-year bond. We're given a cash flow. The cash flow we have here, it's a 4.75% bond. And it pays that annually on face value of 1,000. So we're going to get that coupon every year. And then the last year, we're also going to get the $1,000 back. So those are the cash flows. To find the price, we need to calculate the present value of all these cash flows and add those together. So this is a 6.5% discount rate that we're assuming. So we're going to discount by that rate for every cash flow and raise that to the appropriate number of power. So here it's 1, down here it would be 8. We see the coupon payment present value is decreasing. We also know because the discount rate is greater than the coupon rate, this is going to trade at a discount. So we expect a number less than 1,000 here, quite a bit less than 1,000. Going from 4.75 to 6% is a pretty big difference. So when we add those up, we get 874 for the price. We use a very similar setup for 18, the yield to maturity problem. 8 years to maturity, pays interest semi-annually, so we need 16 periods. And here, we have to be careful with interest rates to remember that these are semi-annual rates, but we're going to be given an annual interest rate. $1,000 face value, pays interest semi-annually 9.5%. So that means our coupon payment is going to be 9.5% divided by 2, because we get half that each 6 months, multiplied by 1,000. And then the last period, we get the 1,000 back. We have our present values, which we'll take these in discount, so divided by 1 plus the rate we're given. Let's say we're not given a discount rate here. That's what we're going to find. So let's put our yield to maturity here. So our present value is going to, for each cash flow, is going to be the cash flow divided by 1 plus the yield to maturity. That's our discount rate we're finding, which will set the price equal to the 1,200 we're looking for. So we're going to divide our yield to maturity by 2 before raising it to the appropriate power. Now, one thing just to check and make sure your setup's looking reasonable. So we want our price to be 1,200, but let's go ahead and put in 0.095 here, because what that should give us, and it looks like I forgot to freeze this, so when we add this up, let's see what we find. We should find 1,000 because our yield to maturity, the discount rate we're using, is exactly equal to the coupon rate. So to find the yield to maturity, let's use what-if analysis. We'll use goal-seek. And we're going to tell it to set the price equal to 1,200 by changing the discount rate. And we end up with 6.28%, which is the correct yield to maturity. Now, something to be careful with here, you have to have in this formula the yield to maturity divided by 2, or else you could get something, you will get something that's not correct, because you'll be calculating the semi-annual rate. So what you would get is 3.14%. You could do that and double it, but I like just being consistent, building in the division by 2, and so it'll just give you the right answer there. Number 19 is asking to solve for the coupon rate. So 11 years ago, we had a 15-year bond. So that means now we have a 4-year bond. And it pays semi-annually, so we need 8 periods. We're going to solve for the coupon rate, so let's put the coupon rate here. Remember, again, the semi-annual problem, so we have to keep that in mind as far as how to treat our interest rates. So we need our cash flow, our present value, and then here our price. So our price that we're looking for is going to be 1,075. So we're going to, again, use goal seek. So now for our cash flows is going to be 1,000 multiplied by our coupon rate. So let's freeze that cell. Divided by 2, because we always want an annual coupon rate. And then for the last period, we're going to add the face value. So whatever we put in here, we're going to get half that percentage. So let's put in 8%. So we would get $40 as a coupon every 6 months. Present value, take our cash flow divided by 1 plus. We're given a discount rate here of 4.9%. Again, that's an annual rate, so we divide that by 2. Raise that to the appropriate power. Add these all together. So we just arbitrarily put in the 8%, but what we want is 1,075. So this looks like we're not terribly far off. But let's use goal seek again. We're going to set that price equal to 1,075 by changing the coupon rate, and we get the 6.98%. So if this bond pays a 6.98% coupon, given a discount rate, the time remaining to maturity, that's the coupon rate we need for the 1,075 price. Okay, number 20. This one's really just kind of being careful. This is the language that I didn't talk about properly before the quiz. So it says last year. So we have to think about last year. The dividend of $1.40 was paid. This is our dividend. This is our growth. And we want to know what happens in 10 years. And for our growth rates, we know we have 3, 4, 5, and then after that it's 5.5 forever. So we'll take our first dividend, multiply by 1 plus the growth rate, $1.44. Take the second dividend, multiply by 1 plus the next growth rate, and so on. So we can fill this down to get 229. So we're just applying the given growth rates, and the only thing here really to be careful with is timing. Just remember that if it says last year, that means that $1.40 was dividend 0. If it says next year, that would be dividend 1. Okay, then 21, the company just paid annual dividend of $2.50. The stock has a market price of 50 and a growth rate of 4%. What is the rate of return or the discount rate in this stock? So we need dividend 1. Because we have that just paid language, we need to take that 250 and multiply it by 1.04. We need to grow it by the growth rate. And then we know that the price is equal to dividend 1 divided by R minus G. So we can fill this formula in and then solve. So we know that 50 is equal to 2.6. We know the growth rate is 4%. We need the discount rate. You could do this with goal-seek also. Let's say 50 times R minus 0.04 is equal to 2.6. So 50 multiplied by 4% is going to be 2. So 50R minus 2 equals 2.6. So 50R equals 4.6. So we should be able to take 4.6 divided by 50 and get the 9.2%. And this 9.2% is going to be our rate of return or our discount rate. Okay, so on to 22. Company has 100,000 shares outstanding, sales are 5 million, and a profit margin is 7%. What is the current value of the stock if the PE ratio is 12? So we can do this a couple of ways. PE is the price earnings ratio, which could be price per share over earnings per share. Or it could be the total market value divided by net income. Price per share in net income is just taking these two values and dividing by the number of shares. So let's look and see what's easier there. I don't think one's necessarily easier than the other. So let's go ahead and let's use this approach, the market value approach. I think that's slightly easier. So we need price. We don't know what that is. And that's going to equal market value divided by net income. Market value I'm sorry, I said price here. PE equals market value of net income. So we need to know the value or the price of the stock. So what we're going to find here is total market value and then divide by number of shares. So we have 12 for the PE ratio equals market value, which we don't know, divided by net income. And net income is going to be the 5 million multiplied by 7%. It looks like I'm missing a zero. So $350,000. So to find our market value then, we're going to take 12 multiplied by the 350,000 So we get 4.2 million. Now we just divide that by the number of shares, which is 100,000. To get the $42 per share price. So again, what we've done, we know that the PE ratio, we can take that as the total market value divided by the total net income. We're given a PE ratio of 12. By taking the sales multiplied by the profit margin, we find net income. And then from there, that lets us solve for total market value, which we divide by number of shares to get back to the price per share. 23, 24, 25. Those use the same info. So we have a project, we've invested $50,000. It's going to pay us back the same amount, the $9,100, for 8 years. So these are our cash flows. And we're going to let, we can do this a couple ways. Let's do the kind of the long way here for net present value. So we're going to take each payment divided by 1 plus the discount rate we're given, which is 9%, and raise it to the appropriate power. Nothing happens to the first cash flow because it's times 0. I have all the other cash flows, and then NPV is just the sum of these. So we get a pretty small NPV relative to the investment. We get $366. What that tells you is our internal rate of return and our modified internal rate of return, those are going to be pretty close to the discount rate. You're not earning a lot in excess of your required rate of return. For internal rate of return, we can just simply grab all our values. Same thing for modified. So these are questions 24 and 25. We have to put in our finance rate and reinvestment rate using the 9% discount rate there. And I made another mistake. Okay, missing comma. So these are rounded, they're 9%, but let's look at some decimal points. So 9.2 for internal, 9.1 for modified internal. For a project with a positive NPV, internal is always going to be a little bit higher than modified because you're making that more aggressive reinvestment assumption. Here you're assuming you can reinvest at 9.2% for internal. For modified, you're only assuming you can reinvest at 9%, the discount rate. So that's going to lead to an overall slightly smaller rate of return. This next one, 26, is very similar to number 1. We want to know, as a result of taking on this project, how does networking capital change? So let's, this is 26. Say time, so time 0 when we start, time 1 after the project. And we're given AR, inventory, and accounts payable. And really, we're just calculating net working capital and seeing how that changes. So we start with 20,000, 31,000, and 15,000. And then after the project, because the company is going to change as this project is added, we have 22,000, so an increase in accounts receivable, a decrease in inventory, and and a pretty big increase in accounts payable. So let's calculate net working capital, add our current assets, subtract our current liability. And if we take this difference, we're going to take a little bit different here. We're going to take the old minus the new, because $10,000 we've gained that. That's been freed up because now we have a smaller, net working capital. In 27, you have a 5-year project, and we're calculating after-tax salvage value for this asset. So it's a 5-year, the starting book value, so we'll call that book value 0, is $500,000. It has a 10-year life and will be depreciated straight line. So depreciation per year is going to be the starting book value divided by 10, so $50,000 per year. So that's always the same. Let's move these over. So our total depreciation is going to be the sum of that $50,000 depreciation each year for 5 years. And call this book value 5. We're going to take our book value we started with, the purchase price, subtract total depreciation. So we depreciated half of it, so these are the same. Our ending book value is $250,000. The sale price, what we can get for this, not a very good deal relative to what we have it on the books for. We can only get $75,000. So now we have our capital gain or loss. Our capital gain or loss here, we're going to take our sale price and subtract what it's worth on our books. So we have a $175,000 paper loss. Not good, but at least we have a tax benefit. The tax rate is 35%. So the tax result or the tax implication, we're going to multiply the capital loss by 35%. So we get to reduce our taxes by $61,250. The equation for this, it can be confusing, so I like more just kind of thinking through this. But the after-tax salvage value is going to be the sale price. In this case, we have a tax savings, so plus $61,250. So it's going to be the $136,250. If that were a capital gain, then we would have to pay $61,250 in taxes. So last is 28. We have sales units of 1,000 for our base. Actually, we don't need to worry about price because we're talking about best case, worst case cost. Variable cost of 30. That's our base. Fixed cost of 15,000. That's our base. So we want to see what's the worst case for us. So the worst case here for a company is lower sales and higher variable, higher fixed costs. So our sales are going to be plus or minus 5%. That's what we feel our worst and best case are. Variable cost 3% and fixed cost plus or minus 1,000. So let's go ahead and fill in the best and the worst case for these. The best case for sales is going to be 1,000 multiplied by 1 plus 5%. Worst case, 1,000 multiplied by 1 minus the 5%. I'm sorry. Yeah, 1 minus 5%. Best case for variable costs, we would have our 30 multiplied by 1 minus the 3%. Lower cost is better. Worst case, 30 multiplied by 1 plus 3%. Higher costs are worse. And do the same thing here. So we would have for our best case, 14,000. For our worst case, 16,000. So to figure out our total costs under the worst case, we're going to take 16,000 and we're going to add 950 units at $30.90. So that would take us to our 45,355. So our worst case for sales is the lower case. So we're looking at these worst cases individually. I mean, you could have higher costs if you had higher sales, but we want to know if each of these is the worst case. What's that look like for the company? So with lower sales and higher variable and fixed costs, you wind up with 45,355. So that completes the review sheet. If you have questions, please let me know, and I'll be happy to meet with you.